Let's bring in Stephen Nash from FIIG Securities with the very latest on all of this. You know, no change, that's the market's call, but certainly there have been some shocks since the last meeting, and I guess for bond markets, tell me about this. They call it a levy, but come on, Stephen, this is a tax.
I think the bond market has sort of underestimated the effect this fiscal tightening initially, reacting a little bit afterwards with the announcement last week. I think going forward, the question is, will the damage bill increase, and will the response increase with it, and does that take more pressure off monetary policy? And I suppose that's a reasonable proposition right now.
You know, certainly, what does this though do to sort of expectations that they put a cap on it, Stephen? So any growth that might have been crimped, at least we have a time horizon on this. I guess the concern was originally it could have been an open-ended tax.
Yeah, I think it's appropriate that the tax has a expiry date. Obviously, they're looking to garner a certain amount of money to pay for reconstruction, but the question is the full reconstruction fully priced? Do they have accurate estimates? I think they're going on the basis of estimates, and those estimates may get larger over time.
Tell me though, Stephen, this idea that more broadly it sort of brings this idea of balancing budgets, keeping ratings agencies happy. It brings that into stark relief, but come on, you know, we're not facing the kind of malaise, the debt to GDP that we are sort of seeing in Europe, are we?
Look, I think that's exactly what the markets were thinking. We've got plenty of room here. The government will just allow the a little bit of extra spending here, and we might push out that surplus target date a bit further. But I think the government's just being a little bit more careful than it normally would. I think that we're not really in the usual situation where we've got that flexibility. I think they're being a little bit more prudent. Obviously, it's a Labor government, and we're very finely balanced here. That the government's only got a few independents supporting it, and if they lose that support, it's going to be very important for them.
What does it do to growth, though? Projections that, you know, on the one hand, the Reserve Bank can sit back now that the government's doing some of the spade work for it.
Yeah.
But in turn, you've got to be looking at maybe new price pressures coming into play. I mean, it's sort of unintended consequences, isn't it?
Yeah, we'll have the effect of the reconstruction, and there will be obviously the fruit and vegetable price increases. But also, I think, you know, over time we've seen this effect from imports being quite weak in terms of prices. I think part of that is due to the currency, and part of that is also due to global excess capacity and downward pressure, and I think that's probably going to continue as well. That doesn't mean that the RBA is going to say, well, everything's fine. I think the hawkish tone possibly will continue, and they'll be very careful about the outlook. They're not going to say that the pressure is completely off. Obviously, they'll say that monetary policy is appropriately tight right now, but I imagine some of their forecasts may drop in terms of growth and inflation a little bit.
So yeah, I mean, the low December inflation print, what does that mean actually more broadly? And for the bank's own forecasts, I guess that won't be revealed so much today though, will it? That may be a Friday projection. Yeah,
we've seen a lot of partial indicators that indicate that the non-mining sector is getting a little bit on the weak side. Credit figures, retail sales, those sort of things are already been quite weak, and I think the bank will put those all together with the statement coming out at the end of the week. Yeah.
Indeed. All right, well, let's just move offshore then, shall we, a little bit, because this idea that, you know, you've got one key economy in that region, that is Egypt, which has kind of remained outside the extremist tent, and yet you do have forces within it that will use any opportunity to, you know, to take hold. And then maybe the contagion effect. What are you hearing?
Well, I think that's what the market's really worried about. It's not really Egypt, it's about the region, and that's a very important producer of oil, that region, and they're worried about these riots taking place in particularly countries that produce a lot of oil. I mean, there's also already talk about Syria, but that's not that important. But you know, it's a regional issue, and hopefully it can be contained. But if it can't, that's the real wild card here.
You know, the likely response, they're saying this is Barack Obama's first foreign policy test. He has to act fast, but as far as you're seeing, you know, he seems to be taking a bit of a back seat.
Look, I think the US has always been accused of meddling in various foreign affairs, and particularly in the Middle East. And I think in this case they've got to be very careful, given the proximity of Israel, and they've got to be seen to be, I suppose, independent. But they are calling for a greater democracy there, which I think's a fair call.
Someone said when Omar Sharif says it's time to get out, of course, you know, that sends the writing on the wall. He you know, Mr. Mubarak, and you've got sort of, you know, someone of that stature making a call like that. It's time to run for the hills.
Look, I think a change of regime there would probably clear things up, and hopefully, as I said, contain the situation. Because the longer it goes on, the more I think the potential for it to spread to other countries, and that's what the market's really concerned about here.
Do you see it? Do you see it sort of having, though, a spillover into global growth? Just as the US, people are saying the numbers are looking good. You know, consumers, sentiment on a knife edge, that could all come unstuck with gasoline prices pushing $4 a gallon.
People are worried about the closure of the Suez, which I think is unlikely, but the effect on the oil price is something that, particularly in the US, would be damaging. You know, we've got evidence of some recovery there, but another spike in oil prices would act as like a monetary policy tightening there, and could snuff, you know, stop any recovery. So we're a little bit concerned about that, and I think that's what the market was doing last week.
Brief final thoughts as well. We had the State of the Union address from Barack Obama. We had a Republican response to it. How are you judging the way both sides of politics are now looking at their own domestic economy?
Well, I think the Republicans, you know, have got to be careful about. There was calls of the US being in a financial crisis. They've got to be careful characterising their debt at the moment, because the rating agencies have already warned the US about the levels of debt, and I think the administration's already reacting to that. I think that's really positive for the US Treasury market. Things haven't concluded yet, so we need more time to see what the administration's going to do, but hopefully we can get a lot more cuts going through and get that perception of supply contained, and hopefully get those yields a bit lower. I think lower Treasury yields would really help the US economy right now. I think that's what the administration's targeting.
All right, all eyes on their next move. Stephen, many thanks for now.
Okay, thank you.
Stephen Nash there from FIIG